The following podcast was recorded on Thursday, June 26, 2025, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or biancoresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by Jim Bianco of Bianco Research. Welcome, Jim.
Hello.
Today, Jim's going to answer the question, is the Fed becoming politicized? Jim, yesterday, Team Trump launched its most coordinated attack on Powell in an attempt to influence a rate cut. But why would Trump want to appoint his successor early? The Wall Street Journal reported yesterday that Trump's reporting the appointment could be on the Powell's successor as early as September or October, but Powell's term doesn't end until May 2026. Can you explain?
Yeah, so as you're looking at on the screen, here is some of the examples of the attacks that we've seen on President or Jay Powell by the administration, and it continued today, not an hour before we started recording this. President Trump is out again demanding a 200 to 250 basis point cut in the funds rate, and he's suggesting that he might appoint himself as the Federal Reserve Chairman. Now, the Wall Street Journal, as you pointed out, said, look, he might appoint or say who's his nominee will be in September or October, like 9 months or so ahead of when Powell's term ends. Why? They've referred to this as the shadow Fed. They want to have basically two Fed chairmen. You can go out and you can listen to Jay Powell and listen to what he's going to say and what it means for monetary policy. Or our nominee can go on CNBC or Bloomberg or Fox Business and say, forget what Powell's doing. When I get there in May, we're going to take a right turn or a left turn and do something completely different, leaving the market to say, should we be listening to Powell or should we be listening to the new guy? And as we get closer and closer to May, the new guy or woman view is going to take precedent over Jay Powell's. So that's why they would probably do it early. President Trump has made no secret that he wants interest rates cut. Now, if we go to the next slide, the question is, who's going to be the next guy? Well, here's the betting markets. And again, think of that as the point spread. You know, people bet because they want to make money. They don't want to make a political statement. And it gives us an indication, and it makes sense. What you'll see in this chart here is that the leader in orange is Kevin Warsh. He is at 20% likelihood, followed closely by Kevin Hassett, the National Economic Council chairman. He's at 18%. Scott Bessent is at 14%. Judy Shelton's at 9%. A couple of other names that might be out there that don't have betting markets for us: Chris Waller, David Malpass. Those are other names. Chris Waller is a current Fed governor. David Malpass was the chief economist at Bear Stearns and then became the head of the World Bank, appointed by Trump under Trump 1.0. So those are some of the names that are out there right now. And we'll have to see where they go. But what I'm afraid of with the politicization of the Fed, and I'll tease this for the next section, is that everybody knows that Powell's not going to get reappointed. And so a lot of this might be, especially when it comes to Kevin Hassett and some of the other players, posturing by them to try and curry favor with Trump to be appointed as the next Fed chairman.
So Jim, how does this relate to the July meeting?
Yeah, so if we go to the next chart, it's all coming down to the July meeting. Here is the probability that the Fed will cut rates in July, in green. I pointed out there in some of the labels that on the one and the most to the left near the top, it says, Powell presser, no hurry to cut rates. The July meeting a week ago from the day we're recording June 26th, a week ago, it was an 8% chance that they were going to cut rates in July. Now it's at 26, 27%. And I've pointed out that Fed Governor Waller last Friday, before we were recording, said that he would be open to cutting rates in July. Fed Governor Bowman, these are both Trump appointees, said she would open the door to a July rate cut. And Powell spoke earlier in the week during his testimony before Congress, and he pushed back and said, look, we're in no hurry to cut rates, but yet we still keep creeping towards a potential rate cut. Now, to be clear, 27% is not meaning that we're going to get a rate cut in July, but we've gone from 8% to 27% in a week on basically no economic news. About the only economic news we've had in the last week was the end of the Israeli-Iran war and about a 15% decline in crude oil prices. Now that's helping lower long-term yields. You know, we're down at under 430 on the 10-year note, but there wasn't a big premium put into the idea that the Fed would be having the spike in crude oil prices affect policy in the beginning. So this is all about the idea that we could see this politicization of the Fed. Now, the way I've termed it is the next couple of meetings, the next couple of important economic releases, July 3rd, the payroll report, July 15th, CPI. If either one of them is weak, or both, or maybe that we get an upsurge in initial claims or something surprising that suggests that the economy is weak, we will see a chorus of Fed governors that are angling for the job, like Waller, maybe Bowman, and Kevin Hassett and the like, screaming that the Fed has to cut rates immediately. And they will put Jay Powell in a no-win situation. If he pushes back and says, no, we're not cutting rates in July, but the consensus on Wall Street is right, and they cut them in September or the November meeting, it's September, November, the next two meetings, then the criticism would be, see, you cut them anyway. You didn't cut them in July. Trump is right. Powell is too late. That's his nickname for him. He calls him too late. And so he doesn't win. The only way he wins is if he doesn't cut rates and then the economy heats up to justify no rate cuts at all. So what you'll see is, I think what you'll see is you'll see people like Waller, like Bowman, like Hassett, try and get into the good graces of Trump because he's going to decide who the Fed chairman is if he doesn't pick himself. And if I scream the loudest and the hardest for immediate rate cuts, maybe Trump will say, I like you, you could be the guy.
But what's the risk if they cut rates too early?
The risk is, if we go to the next chart, the risk is that they are stimulating an economy that doesn't need it. And that would produce stronger growth, higher inflation, and a backfire on long-term interest rates higher. Remember, I've said this many times on this podcast and other places. September of last year, the Fed cut 50 basis points. Then in November, they cut 25. In December, they cut 25, less than a year ago. The 10-year was at 3.6% when they started cutting rates in September. By January, it was at 4.8. It went straight up. It was a rejection of the policy. What the market was saying was, you're cutting rates. We don't think it's necessary for the rate cuts. In fact, we think it's going to produce more inflation, and that's what happened. Could that happen now? Let's take a look at this chart here. This is trueflation. Trueflation is an internet scraping where they look at millions of internet prices and they aggregate them into like a daily CPI. Now, most of the things you see on the internet are goods, right? You don't, get quotes on Amazon for teeth cleaning or to get your lawn mowed, but you do for products. And products tend to have lower inflation than services. So it's the rate of change that matters here, not necessarily the level. As I point out here in the red box in the middle, on May 1st, Trueflation was saying that their estimate of CPI was 1.35%, lower than what we're seeing, but again, because it's mostly goods. And then the box on the left says that since May 1st, that's 7 weeks, it has risen to 2.22%. It has risen now almost 0.9%. And you can see that green line on the right showing that we've been in a solid uptrend in inflation. Now, what this is, in my mind, evidence of the tariff-driven inflation. Tariffs are a tax. They're increasing the prices of goods. It's showing up in internet prices every day. So one, what is the risk of them cutting rates? They're going to cut rates anyway. They're going to do it into the face of higher inflation. Second, if we go to the next chart, is at least for the month of June, This is the national average of gasoline prices as surveyed every day by AAA. AAA surveys every gas station in the country, and then they put out a national average. They put out state and city averages and all kind of others, but this is the national average. On June 9th, it was at $3.12 a gallon. On June 15th, which was a week ago, basically, it was at $3.14 a gallon. Now it's at $3.22 a gallon. So we've gone up 7 cents. The point is gasoline prices are going up. They're volatile. They also factor into CPI. They're pushing them higher. If we go to the next chart, this is the Atlanta Fed GDPNow last estimate for overall growth. Remember, GDP is like a summation statistic. All the other statistics go into it. Now, this was last updated on the 18th. It's going to get updated on Friday, the 27th, which is the day after we're recording. I'm estimating it's going to go higher, not lower, but even still, it's over 3% growth right now. The economy is fine at over 3% growth. And what it is suggesting to us is that the rate cuts are really not necessary. Add into it, as we're talking, as I look at my screen, we're less than 20 S&P points away from an all-time high, which was set on February 15th. So that begs the question, what is the thing that we're trying to address when it comes to a rate cut? Is it that the economy's slowing? No. Is it that maybe there's some weakness in the economy? Well, maybe, and a lot of people point to housing. Let's go to the last chart here when it comes to housing. So this is the Case-Shiller Home Price Index. When you ask people, what's the state of housing? They go, I'm worried sales are way down. Mortgage rates are way up, meaning that the average home price, if you left your home and got a new home with a new mortgage, is higher. Well, here's the problem. The Case-Shiller Home Price Index and other measures are at all-time highs. What I would argue is if the Fed were to cut rates because they said, look, home sales are down, what you'll do is you'll just see the seller say, oh, so you're the buyer, your monthly payment went down because the Fed cut rates and presumably mortgage rates went down, I'll raise my price. And we'll be right back to the same monthly payment that we are at right now. And that's why, ultimately, to me, the biggest measure of the housing market is its level. And Case-Shiller is saying that it's going up. So I don't see a need to cut rates. I don't see the economy being weak. I see inflation being sticky with tariff inflation potentially coming through, gas prices being high. Home prices are not weakening as of the moment right now. The risk is what we had last September. The Fed, under political pressure, especially from those within the Fed and those outside the Fed that want Jay Powell's job because he's not going to get reappointed, are going to force a rate cut that would produce much higher long-term rates because the market would say it's not necessary. If the Fed holds the line, here's the political part. What if the Fed holds the line and Jay Powell says, no, 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 we're not cutting rates, pushing back, fighting tooth and nail, we don't cut rates, and then things do turn down. The economy does produce slower growth. Inflation does roll over. The stock market does correct, and he didn't cut rates. Now the Fed is going to be under unbelievable pressure. So there's one path for Powell. Don't cut rates, hold the line on it, and bet the economy stays strong, inflation stays sticky. There's never a reason to cut rates going all the way into 26. See, I was right. There's all kind of paths that is not the case, in which case the Fed's reputation takes a big hit, Powell's reputation takes a big hit, and the Fed gets increasingly politicized. For the short term, I think it's going to come down to those payroll report on July 3rd and the CPI on July 15th. If either one of those is weak, it's going to open the floodgates to criticize the Fed and demand rate cuts. If they're both strong, it'll push them off at least for July, and then we'll have to start this game again in August to see how that goes for the September meeting. So the Fed is becoming more and more politicized right now. President Trump and all of this constant attacks from the administration and people that want his job I think cumulatively are taking their toll on the Fed. That's why we went from 8% to 28. 28 doesn't mean we're going to get a cut. We've done that in a week with no data. We get some weak data points. We could be at 45 or 50, and we could have a very different equation. And then we'll have to see how long rates react to it. Do they like the idea of a rate cut? Or are they saying, no, you're just stimulating and creating more inflation, and I don't want to own 10-year and 30-year bonds, and they sell them off and yields go higher. So we might be entering into a new realm. We'll have to see how that plays out in the days and weeks to come.
Thank you, Jim, for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research or Bianco Research, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks again and have a great day.